welcome to the Capital Discussions Roundtable. I'm Tom Nunemaker with Jim Riggio and our guest, Paul Demers. Before we get started, just a quick disclaimer, the Capital Discussions is not a broker-dealer or an investment advisor. This presentation is for educational purposes only. We don't know your situation and have no way of knowing what level of risk is appropriate for you. We're not making any specific trade recommendations. The risk of loss in trading options can be substantial, so please be aware of all of your risks prior to placing any trades. Hypothetical computer simulated trades are believed to be accurately represented. However, actual profit or loss may vary due to market factors such as liquidity, slippage, and commissions. Try to get through that fairly quickly, and if people want to read the whole thing, it's at the bottom of all of our websites. But while we're switching the presenter role, Paul, welcome, and I know you've gone over this Weighted Vega stuff at Trading Group 1, so maybe you and Jim want to talk a little bit about it before we get started.
Sure. Paul, while you end up getting your stuff up, Paul and I have talked about this a number of times. Basically, here's the concept as an overview. Implied volatility, okay, in the short term, okay, moves much faster than it does in the long term. Okay, you'll end up seeing that. One of the things, I had lunch with Sam Russo today, and one of the things that Sam and I was talking about is that I was explaining that just because the implied volatility is very low, let's say at 30 days, like in the VIX, doesn't necessarily mean that it's very low in the 1-year volatility or 2-year volatility. And one of the things that we have looked at, okay, and we being Paul and I, is that we've looked at understanding that just because volatility goes up and Vega is a calendar is a long Vega trade, doesn't mean you make money. And with that, as we went through back and forth, Paul has spent a lot of time on it. And so, we've been asking him now for a while, and he's just been too busy being Mr. Construction Man, as I'm sure he'll end up telling you, okay, with his pickup truck on his first slide. Okay, Paul, tell us the background of the pickup truck.
Well, this is the first time I've done a PowerPoint presentation, so I kind of wrote everything down, and I showed it to a friend of mine, and he said, I made some changes and take a look, and he made it look a lot better, and he put that picture on the front page. At first I thought I might, I was like, I don't know if that's appropriate, and then the more I thought about it, it's like, okay, well, that kind of works. I've been fixing one house or another for about a year. And what's interesting with that is I've been trading the new trade that I've been doing all within that time frame. So there's been a ton of distractions with it. And I'm very pleased that it's, even with the distractions and my mistakes being a new trade, that it's working out pretty well. So there's a lot of hope for the trade going forward. But that's what the story is with the pickup. My wife's in real estate. She always buys houses that need work, and I'm it.
That's why I love the line on the back of it. Call Joanna at 1-800-HIRE-PAUL. Paul, right. Please do this. Paul, please do that. So yeah, that's very, very fun.
Yeah. So.
And so we're calling you now to end up telling us about Weighted Vega and what you've been trading and what you've seen, okay, with some pretty big spikes in volatility, right? Paul, you and I had spoken that in the fourth quarter, the VIX had 2 of its largest weekly moves in its history. So having trades, okay, and being able to deal with Weighted Vega in this environment, I think is more important than ever.
It was the whole experience with, let me show before we get started, and I've talked about this trade in the different groups before, but basically what I'm doing is combining calendars, which are up here, with iron butterflies that are down below the money. And they're usually long-dated calendars because of what I'll talk about in the presentation. And they've been working pretty well, but it's a whole different thought process to what we were all taught as far as, the deltas in the positions and what they mean and how they affect the trade. So it's been a very interesting learning experience for me going to the next level. And with that, this is my first official presentation. Usually I will just get on one of the discussion groups and quite honestly just babble about. So this will be a new experience for me. So in the beginning, when I took my mentoring, they wanted everybody to do calendars, and I could never make a calendar make money. So I never did them after that. It became, what's a calendar? Was my favorite line. And it's been interesting once I discovered what Weighted Vega and started poking around, looking at it. It's made a difference in my thoughts on the calendars, and now I'm very comfortable doing them. As you can read here, it's one of the more challenging types of trades to do. The butterflies, the iron condors, they're all in one expiration cycle. And the market moves and the volatilities, when you're in one cycle, it tends to affect the different strikes equally. So once you start doing a calendar, you now have strikes in two different expiration cycles. And like Jim talked about, the front month moves and changes and has much different its own dynamics compared to the back month. So now you have that complication involved, when you're in the middle of the trade trying to make money. So let's see, the other thing that I want to mention is, the back testing and the modeling, especially with calendars. It cannot give you anywhere close to what you're going to witness live. And so part of that, the process with the trade that I'm doing now, people that know me know that, and Jim can attest to this, that I'm a back testing junkie. And I usually back test everything to death before I trade it. And the reality with this trade is I back tested the trade to figure out the trade itself, which vehicles I wanted to use below the money and above the money. And I fiddled around with very minimal back testing, and I decided that my back testing would be live. So once I really started getting into this Weighted Vega, I wanted to find, there was a lot of discussion about the front month and the back month. The volatilities are different. It affects each strike different, which you can see, if you go to VIX Central and you look at the graph they have on there, you can see how it affects the VIX futures. Well, that's really kind of a mirror of how it affects the option pricing as well. You'll see the front month goes way up and the back months don't go up as much. So you end up having your short in the month that has the most extreme volatility. So even though you think you're going to make money going down with positive Vega, a lot of times you don't make any money going down and you're scratching your head why. And that's what I did in the beginning. But, once, reading up about this Weighted Vega, went on this quest to try and come up with some, mathematical relationship. How do you know how, when you're modeling the changes, exactly, what amount of front month to back month do you move the volatility to get some kind of reasonable expectation of what the calendar is going to do in that environment? And I have bought Taleb's book, Dynamic Hedging, quite a while ago, and I first read it, and I'm not a math person. So, it was a very difficult read, so I put the book back on the shelf. I've since taken it back out because when I started looking around on the web, the Weighted Vega discussions, all kind of, majority of them led back to his name. And so I've reread the book probably 3 times, and I'm starting to understand it a lot more. And there is a lot of very interesting information about not just calendars, but how to really understand the Greeks, what they mean and what they don't mean. So out of that, I found I had showed a spreadsheet that looks similar to this with some calculations on it that I found on the web. And after reading Taleb's book, I did not have the formulas exactly correct. So how he looks at the Weighted Vega is he calls it a pillar. So he uses a 90 DTE expiration as the time frame as his standard. And then he bases all of the data off of that based on the current DTEs in the trade you're in, or the trade you're looking to get in. So, it's the square root of time. And you take the square root of the pillar, which is 90 days. The anchor DTE is 90 days. So it's 90 days divided by the current days to expiration. So you can see here I have 9 DTE and 23. So you do your calculations, and it comes up with this ratio. And what I did is I broke it down to come up with an input that I can put into TOS. This is a increase of volatility by 1 point. So and I'll show you the slide how I do it in TOS. So if your front month moves up 1, your back month only moves up 0.63. And you can see as you go out in time, the numbers change. And it's based on, because of the amount of time left. And this is what I discovered why I started doing this trade using 60, 70-day calendars versus 30-day. Because this has much less movement between the 2 strikes. And you can see here, I'm sure everybody knows this, has opened this up to take a look, where, you can go in and change your volatility in your stock price and yield to model different, how the effect on volatility is, either up or down. So when you're doing calendars, you will get both strikes, and you can see I've modeled it for a +1 and a +0.63. And that gives me a better understanding looking at the graph as to what I can expect, in this case, in the market going down. So I did a small back test. And I used very short time frame calendars. And it was a 9 DTE for the front month, and the back month was a 23 DTE. And I decided to use that being close to expiration because it helps magnify the effects a little more than a back month. And so the trade was put on at the close on the 27th, this day, and then the numbers came from the next day at the close. And the implied volatility had changed 2.31, and the RVIX changed 2.36. So I went into option view and I put the actual trade on, and these are the results of the actual trade. So you can see that even though the market went down, and it didn't go down as far as what we're used to, it didn't go down a lot. 19 points. I mean, that's just a day. As far as I'm concerned now, that's just a day in the life. So you can see how the calendar actually performed. You know, it was 8:05, and the market moved down 20 points. You have positive Vega. The IV did go up, and you're down money. Not a lot, but it did not go up.
Hey, Paul, was that an at-the-money calendar?
Yes, I'm sorry. This was an at-the-money calendar. The next set of slides, I duplicated the time frame, and I did one equally weighting the Vega, and then one weighting the Vega as Taleb describes. The IV numbers from the option view results as a benchmark, these numbers here. And I needed those numbers to calculate out what the modeled prices of the options were using Black-Scholes. And you'll see that there's a slight difference in opening prices between these and these prices. And I think that's normal. You know, where the Black-Scholes is giving a modeling of what the price should be, and these are the prices based on supply and demand. So, you know, that's the other thing. The Black-Scholes is a model. It's not the exact prices everything should be. It's a guess. So here are the results when I weighted the front and back month equally. So when the market moved up or moved down and the volatilities moved up, I moved the volatility up at the same rate on front and back month, and then calculated out what the prices would be based on Black-Scholes. And you can see that that price is higher. And so this is something that you would model, you know, the day you put it on, you would model the trade and just bump the volatility up. You would see this in your model. So you would say, I'm good. You know, I'm going to make some money, the market goes down. And these are the results using the weighted Vega based on Taleb's formulas. And you can see that it's also down. And it's fairly similar to what actually happened. And I brought this up just because, you know, I want to quantify, and this is just a caveat, this is just one instance. I've looked at, you know, maybe half a dozen, and they all fit this. So I'm getting a feeling that the calculations for Taleb are pretty close. But I want to do more instances where I can make sure that, you know, I'm looking at the right formula and I don't have to tweak it around. Let's see. And I thought this is the the trade that I showed, in the beginning on I think our swim, I have been, one is my 9th cycle of doing the strategy using these long-term calendars and the butterflies. And, with having some missteps and not being focused on the trade as much as I should have been, it still has based 14 wins and 2 losses. I run one in the SPX and one in the Russell all the time. And these are the average returns. It's 5% a month. So I'm fairly pleased with that. And I think the calendar trade needs more attention to understand the dynamics of it and how to adjust it and what to do, because it has its own little quirks, like being able to close them when you really have to. But so far, everything has been working pretty good. And I'm thinking that, all this testing has led me to initially to want to be out far enough in time with him, not to have the front month, the short strike be in the front month. And I'm still trading it like that. But I think that the more I'm getting into this weighted Vega, I think there is a place for the shorter term trades.
Hey, Paul, these trade results, is this your kind of combination trade?
Yes.
Okay. And then we did have a question, do you trade calendars on the RUT only?
No, I do them in the SPX too.
Okay, and then Steven says, sorry if you mentioned this already, but what problem did this solve?
Basically, the issue for me is understanding how the calendars work. You put them on and they do things that you don't understand. I don't like that. I at least like to know why the trade is losing money with positive Vega. So this is more of a better understanding of what I consider a very unusual trade because of the use of the front and back month.
Have you found any trading software modeling better than other trading software, or they are all about the same?
They're all about the same. The only one that, looking at the graphs when I changed if you only have one volatility number to change, and then I haven't actually looked at that live vol to see how they handle it, but OptionView appears to handle some of the weighted Vega, where if you just use the front, if you just change the one number in toss, it does not.
Yeah, I know OptionView does use multiple months because I had suggested to Len that he turns off some of the updating for the live broker trades because it can be kind of slow, and he said if he did that, then the modeling wouldn't work because it's using multiple months or multiple expirations. And Andy's asking, what's the time duration for front month and back month calendars? Can you describe a typical trade?
Sure. Typically they run, let's see if I build one. Simulated trades. We're getting in a little close. May's 56 days. I'm actually starting late, so I'm just starting a May trade now. And do I have it? Okay. So I do a lot of my trading based on what I see on a graph. So we are up in this area, and we can keep going up, as you can see here. But when I get up in this area, I will typically start with the butterflies below the money and then manage it. If we keep going up, I'll very cautiously add calendars to it. And everything I do is 30 points above or below the money. So if I wanted to, let's see, that's at 20, 50. So these would be, actually, that's a pretty good price. Four. So that's typically a combined structure. If we're in the middle of the Bollinger Band and I'm not sure which direction we're going, this is typically I'll start like this. If we're at the top of the Bollinger Band, I'll start like this. And if we're at the bottom, then I would start like that. And usually they're out further in time, 60, 70 days out. I just got busy. Yes, 40 wide on the calls, 50 wide on the puts. I run this unbalanced. This is a lot like John's M3, and because it's a 40-point wing on the front, I can almost get away without having to buy a call, because I'm going to use these calendars to pick this end up to find my profit zone. I've done this trade where I think my short strike has ended up 100 points away from at the money by the time we're done. And it's turned into a calendar trade up here, and the butterflies have turned into hedges for the downside. And you just end up putting enough calendars on to make money, to pick this whole line up so you can make some money up here. And what I find is let's see, can we do, I don't think we have July's yet. When you look at this, these become pretty resilient. This is too wide and it's way out in time. But I can let this go 2020 before I'm getting concerned that I should do something, because a month from now, let's see what it looks like. It'll start picking up in here. I don't like doing the 2-month, so I'll try and wait until there's 1 month between. But I have done them because I've felt I needed to have something on the top. Well, I'm not sure. I don't find this. I like the M3, and I do the M3 as well. This is from, I think it's Stefan or Steven. I'm not sure which. And he asked, why do I find the structure superior to the standard M3? And I don't. I like the M3 a lot. I trade it. This is just a different, this is a whole different trade. And I'm doing it because I don't adjust these generally. I'm more interested in taking them off and putting them on. I have found that I end up tweaking them towards the end. So today on the Russell trade that getting ready to take off, I've rolled in reverse Harvey the long calls just to flatten things out so I can leave it on and let it sit for a few more days. But generally, either, if the calendar is getting in trouble, either flattening out the delta to 0 or preferably just taking it off at what I feel is a point of no return. And that kind of answers the adjustments. I tend to try and not fiddle too much with it, because what I'm doing is this is not full size. This is 20% of the size of the trade. So I'll slowly add to this as I go along. So I'm going to try and follow the market around. I've got to the point where I feel that the market, everybody talks about the market reverting to a mean. Well, it does revert to a mean. We just may not know where that mean is at the time we put the trade on. The new market mean might be up here at 1310. But so, and that's kind of half joking. But because we don't know, I used to put very large trades on all in one spot, like right here. And then I would manage around that spot. And I'd have to have this thing kind of meander back to the mean somewhat so I could make some money. Well, now I will put this portion of it on, and we start moving up. And then I'll abandon putting any more butterflies on, and I'll just start adding calendars to it. And the market starts moving back down, then I'm going to start adding butterflies 30 points below wherever we are. So the idea is that I'm going to build the trade around wherever the market's going.
So kind of general rule, you're adding butterflies below like 30 points and calendars above as the market moves around.
Yes, correct. And I look at the market dynamics. If we are coming up on some resistance areas, I might do 20 points above the money on the calendars. So I'm using much more market timing. To figure out, what I'm going to add and when. Jim and I did a lot of work with these butterflies below the money. And, I remember we were doing everything in the SPX. And I remember Jim put one on in the rut to see how it reacted. And I think we both kind of forgot it for a week or two. And the market moved up. And with, way outside the tent. And, we looked at it, and we kind of looked at each other, and it was like, geez, the thing is up money.
It's true.
So, what happens is, and this is one of the things that I'm looking at with this trade. We start moving up a certain point, and it's like, I want to add a calendar. The reality is, if I just have this on right now. And, I can let it go maybe up in here and not panic. Because, I'm going to take this off in 30 days. And you look up here. So the time that I should really panic is up at 1275. Because that's the point of no return when I go to take the trade off, that this butterfly is going to start losing me money and not get it back. I can end up being down money in here in the beginning. But the time is on my side if we stay in here that I'll at least be profitable. So, sometimes, I'm beginning to feel that I'm jumping the gun with the calendars a little too much of putting them on. So, it's where is the adjustment point. This has become for better or worse, more of a trader's trade. It depends on what the market's doing. You know, Yellen became
People
very...
why you put the butterflies below and the calendars above instead of vice versa.
Because everybody else does it vice versa.
Well, that's a good question. I've always done butterflies below the money. You know, it's kind of become like an old pair of slippers. I'm very comfortable with that trade, understanding how it works. So, you know, volatility hurts a butterfly. But because you've got all this room under the tent, it goes to what Jim has talked about a lot, is I'm going through my profit zone before I get in trouble. So I've had these trades on live that I've actually gotten out here and not been down any money. Not made a lot of money because of the volatility. And then the market, we know what happens when we get down here. We bounce really hard and all the vols come out. And now you're down here with a trade that's negative Vega and you're running back up into your 10. That's why I like doing them below the money. The calendars above the money, one of the things that I back tested was different trades to do 30 points above, 30 points below, which, and it wasn't, I wanted to see how they worked, you know, when you picked the correct direction. But I spent more time putting trades on at the worst opportune time. So I would go to look at a graph and I'd say, okay, you know, let's make believe, you know, this is at the bottom of the Bollinger Band, down here. At the top of the Bollinger Band, and you put something on below thinking the market's going to go down, and it goes up. So you've made the wrong choice as far as market direction. What trade would survive the wrong move? And I did that with the calendars. So what happens if you put a calendar on here, thinking the market was going to go up, and it's 30 points above the money? What happens to the calendar when you have this? Or butterfly, or condor, or, you know, unbalanced butterfly. I pretty much tested most of the trades, standard trades we do. I found the calendar was the most, at 60 or 70 days out, was the most resilient, that you had enough time to fix it without getting into a lot of P&L trouble.
Paul, you remember? I don't know if you remember that the institutional guys, they call that shared variance. You want to go over that? Do you remember? You remember the term?
I do a little bit. I think you're more knowledgeable on it, but if I remember right, it's you're looking at the time that the two options are live together.
Exactly, the overlap.
Right?
So what ends up happening if I, just to make the math easy for myself, if Paul ends up selling a 3-month option and buys a 4-month option, 75% of the trade is overlapped. So the variance in the Vega has a 75% shared variance. Whereas if he keeps that same trade on, and let's say it was only a 4-week calendar, not a 5-week calendar, it'd even be worse with a 5-week calendar, right? But with a 4-week calendar, let's say if he has 1 week left in the front month and 5 weeks left in the back month, now he only has 20% of the remaining time that's variance, right? 1 divided by 5 versus 3 divided by 4 in the earlier example. So the more shared variance you have, the more overlap you end up having, the more the trades will move more in tandem. Yes, there's term structure issues that Paul's talking about and everything, but that ends up helping you because your trades are much much calmer, right? They're much easier to manage. They don't get out of control as quickly, no matter what happens, because you have that shared variance.
Paul, there was a question if your spreadsheet is available for people to get.
Let me think about that. The only reason I say that is because I'm not sure that it's totally accurate yet.
Okay, good point.
I'd hate to give that out and people start using it and find that his use of the 90 days needed to be modified to get a much better picture. So I'd like to kind of wait. I don't mind sharing the stuff, but at least, I don't want to give somebody something that, 2 months from now or a month from now, I find, okay, I've modified it and it's totally different now.
So, Paul, given all the work you've done with Weighted Vega, how does that change the way you think about calendars or place them versus what you used to think?
Yeah, I'm looking at some of the questions too. The change in how I will not put a calendar at the money, ever. It's a directional trade. That's what I've come to the conclusion with the Weighted Vega. So, if I think the market's now, I'm doing calendars above the money, butterflies below the money. I've tested doing everything in calendars. The trade works. I have tested doing butterflies above and butterflies below. The trade works. Is much different dynamic. It has to be managed differently, but it does work. I think this system that I'm doing of chasing the market around, trying to collect theta, and trying to, it's like finding the mean that it's going to end in the 30 days I'm in the cycle is kind of like trying to find Waldo. You get little clues. You think you know what's going to happen, and it's like, okay, well, I'm gonna plunk a calendar there, or I'm gonna plunk a butterfly there, because one of these things should end up pretty close to the center. I mean, I have taken a calendar off with a 60% profit, with 30 days to go. It just so happens when I'm ready to take it off, it was right dead center. The other calendars weren't, but that particular one was. So what happens is I look at each piece of the trade separately. So when I'm managing this thing is I am adding pieces on in a size that I can leave alone for as long as possible to try and let them cook and make their money, because I've traded a lot of stuff, and I've had adjustment plans, and I've managed different trades, and some of them fairly large. And I find that you really change your dynamics of the trade once you start adjusting things.
Mm-hmm.
So if I put these small trades on and I can leave them, I've had some of them go down 20 and 30%. But other pieces have made up the difference. So when you look at the aggregate position, my P&L is fine. So, and then a good example of the calendars now let me get back up. It is this one, I think. When we were down here, these calendars were really hurting. But I didn't have enough of them to really feel. I was more I was irritated that I was down that much money instead of worried, because these butterflies were making money. So I kept the T0 line fairly reasonably flat. Now we bounce all the way up. Now the butterflies, you see they're losing money. There's a couple more down there, so I'm not quite down 400, but you can see now this is down in a zone where it's going to lose money, but now these calendars are starting to make a few bucks.
One of the things that I really, really like about the position that you're in, Paul, is that if the market continues to run up, the calendars will end up having theta working on your sides. You know, you're long the back one, and yes, you will become negative a delta a little bit more if you move forward. But if the market pulls back,
oh my God.
Exactly.
I work with there's a small group of us that work together and we trade together. And there was a trader doing triple calendars, and it was amazing to watch the market go away from the center of the triple calendars and the P&L explode up.
Exactly. Now, what I was going to, right, the point that I was saying, if you get pulled back, and when Paul went, oh my God, and we laughed because we've done this behind, can you explain how the whole trade, again, how the different pieces will end up making money if the market pulls back? Because this is the way I view this trade. You right now you're probably risking $1 to make 5. If we end up having the continue grind up, you lose $1. We have not a big pullback, but even, if we pull back, 2%, okay, you're going to make a lot of money. Explain, could you just kind of go through, why you said, oh my God, and I laughed so much when you said that?
Right. Well, the trade, I kind of forget all about the Greeks. Except for one, this one here. So this thing should come off tomorrow or beginning of next week, the latest, because my gamma's over 2. That's a comfortable position for me to be in, personally. That's just a personal issue. So I flattened out the butterflies last couple of days, right here. So if we take those off, so now we have the butterflies here. So as this goes down, what's happened in the last few days is we've run up into these calendars. The shorts being closer expiration, they have gotten, as you can see with the weighted Vega, as the market goes up, there's a lot of buying pressure on the shorts. So the calendars actually don't make any money on the call side, just like the put side when it's going down. It's like the volatility in the calendars, call calendars, goes up when the market goes up. So you patiently wait here while you're not making any money, and what you're looking for is just a very small downtick to get, because the shorts in anything on the put side, whether it's you're doing a condor or a calendar or butterfly, when the market bounces back up, they don't take the money out of those short puts right away. They tend to hang on to it for a little bit. When the market runs up like it did, and if we came down 10 points, if we came down, another 10 or 20 points tomorrow, all the value in these calls comes out immediately. They do not retain their value like the puts will. And I've witnessed it live, and I'm assuming it's because of the skew issue on the call side. They just don't hold up.
Yeah, it's that in the weighted Vega, right? Because what happens is that if you get a pullback this late in the trade, the Vega in that front month that only has another whatever, a couple of weeks left to go, it doesn't have any ability to really jump in value. Okay, because the Vega is so small. Yes, the front month moves higher. I get that, but the back month is more in the sweet spot. So if it pulls back, it's Vega. It's carrying a lot more Vega, and the volatility goes up. So that trade makes money, and you get closer to your butterflies. So you're making money on both sides. That's why it's a double whammy. Whereas if it runs up, you've already lost most of your money out of your butterflies. The front month, okay, but calendar is going to get crushed even further. So you're going to make money on your short front month, and the back month, yeah, you're going to lose a little bit, but it's moving up, so you don't lose as much. I mean, yes, the calendar will lose money as a whole, but it really, I look at the structure, and I do think if it's definitely at least a risk one to make 2.5, probably, risk one to make 3 or 4, sometimes risk one to make 5 if you end up getting a pullback.
Right. And it will depend exactly where you are in the trade and what the market's doing. This trade is really sensitive to what's happening in the market. I watch news, I watch the market, I have all the trend lines. I'm looking at all of that to try and determine where I'm going to add stuff, when I need to make, if we're running up. Like yesterday, we ran up a lot. I was quite impressed with both this and the one I have in the SPX, that they handled the up move yesterday without a hitch and no adjustments. So now I have to, I'm watching it now looking for a small pullback, which we had in the SPX, but not in the rut yet. So tomorrow I make a decision, so what ended up happening is, today I did the final bout of flattening this out. I'm still worried about a pullback, but now I've at least got some room up here to get sucked up into these calendars if we just kind of meander around. And this is coming off in a day or two. So, I'm just in the mode of, I want to keep my money because this, it's 1,900 on 24,000. That's not a bad month for the size of trade.
I like it a lot.
Yeah, it's been working really well. It's, I need to, let's go over some of the questions because there was a couple that. Somebody asked about naked puts. The reason why I don't do naked puts is because I don't do naked puts. I don't do naked calls either. I've read, more than one horror story about 1987, and I'm not interested in going there. I do this full time. That's the other caveat. So the money in the account is basically a tool that I use to make money with, and I can't lose the tool because I cannot pay my bills. So I am very, very risk adverse. That's why the calendars are out far enough in time. That's why, I'm up $1,900 in this trade, and you look at this and there's a lot more money in it. If John Locke takes his trades a lot closer than I do. It's just my decision because I like the T0 lines flat. I'll take less money and feel that I'm not going to risk ruin. A lot of people make a lot of money with naked puts, and they can tolerate that. It's just a personal thing. 'Cause if I took this to the end of the month, there's a lot more money in this thing in here. But that's okay. I'll be on my next one. with, you know, with at that point, you know, almost zero gamma. So I don't care what the market does. You know, once this is off and the new trade's on, I don't care what the market does. I mean, you know, I got 0.14 gamma. This thing can run around all over the place, and I'm not going to get scared out of the trade.
Paul, one of the questions is, do you find that the theta modeling is accurate?
No.
Yeah, no, yeah, I didn't do that.
It doesn't matter what you trade either. This, anything, doesn't matter. They give you they'll give you theta when they're dang good and ready.
Yeah, that's what I found. That's what I found also.
So, you know, I goofballed this trade up, but this trade spent 3 weeks down between $1,000 and $1,100 every day in here, not giving me any of. I just got a bunch back today. And, you know, last week it sat here all week, wobbling around in here, made $0 theta dollars. Very, very frustrating with the SPX system. And that's what happens. It's these numbers. Talib, I was going to mention this and I almost forgot, but you reminded me, thanks. Talib talks about two things. Talks about the black shoals, and that's where we get all these numbers. He in the book, he pretty much, I don't have the exact wording, but he said that black shoals is a model. It's not a predictor.
It's very true.
And the other thing that he said, which I found very interesting, these, you know, the delta, because he goes in the book a lot about delta, gamma, and vega. These numbers, as far as he's concerned, basically, these numbers work fine if you have one option. If you have what he calls a book, which this is a book, and you have more than one option, these numbers as an aggregate are useless. And the reason he says that, from my, you know, reading between the lines in the book and reading what he's talking about, is because this strike is going to act much different than this strike.
Mm-hmm.
So as the market's moving around, your gamma and your vega and your deltas are going to act a lot different on this strike than at this 1250 strike as it is on this 1200 strike. These add them all up together. There's no dynamics about where they are in the skew curve. And everything changes depending upon where they are. So it kind of reinforced the fact that, you know, I look at this whole trade to see how I'm, you know, where I sit with everything. But I'm also going to look at all of the independent pieces to see which one is going to cause me the most pain the quickest. And that's the one I'll focus on to fix.
Exactly. I'm just trying to see if there are any more questions. Which one of Talib's books were you referring to?
It was, let's see, Dynamic Hedging.
I was looking at my bookshelf. That's exactly what I was going to say.
Yeah. It's a good book. It's a tough slog for me because I'm reading all of the formulas is pretty difficult, but I can read around that and get what his intent is.
Oh, it's difficult for me, and I actually did that shit back in college.
Yeah,
Don't feel bad.
Yeah. David made the comment, and I make that comment all the time. You know, these guys won a Nobel Prize for the Black-Scholes modeling, and they are the same guys that blew up long-term capital management. So, I mean, we do have to take, you know, everybody believes the Greeks are gods. And the reality is the same guys that came up with those numbers are the ones that blew up, you know, I don't know how many millions of dollars.
Exactly. Don't forget they're engineers, right? And when you want to think about how engineers think practically, and by the way, I get to say this because I did both my undergraduate and my graduate work. Think about how practical engineers are. They put a man on the moon before they put wheels on luggage.
Yeah, pretty much.
Okay, think about that for a second. Okay, so now you know how they end up thinking. Anyway, Paul, I don't. Anything else that you kind of want to end up closing up with, because we've been going just about an hour, and I want to be cognizant of time.
Sure. It's just, you know, I hope the presentation was good enough. I did it this morning because I got the email last night that I was presenting, you know, to come join. You know, and I have 2 bathrooms torn apart that I'm trying to get ready for plumbers and electricians next week. So I was like, uh-oh, I need to spend some time. So I started last night, and I stayed home today, and I put this together. So I hope it was okay and everybody enjoyed it, because it's
I thought it was great. Okay, let me share what Paul ended up actually saying, too, before. He opened up the email yesterday saying, oh, I wonder who's speaking tomorrow. Oh, crap, it's me.
Right.
So, anyway, Paul, I know a lot of people have asked you this, and they've asked, you know, Tom and I this. When are the houses going to be done so that you can end up actually, you know, having a trading room and starting to show people this stuff?
Well, it depends on 2 things if she stops. Once she stops figuring out that she wants to do more work, we're getting one house ready to sell. So that's been a big push. And I think, you know, that'll be about another month and a half. It should be ready to sell. And then I should be, I'm hoping to have a break before she buys another house.
Well, we hope you do too, because, you know, I want to make this one comment. If you want to end up learning how to end up trading options, there is no better way than to end up seeing how different trades work against one another. Having said that, Paul's trade is probably the single best trade I've ever seen when it comes to the ability to end up learning about trades. You know, I've spoken and I've done a lot of different trades. You know, John Locke and I have had conversations. Love the concept of the way he's doing his trading, but there's very little that you end up learning in and around term structure if you're trading a butterfly. Having the multiple components allows you to end up picking the trade that is less expensive and gives you a better risk reward for a given market. You know, you do need to have, I don't care how good of a fastball pitcher you are, unless you're, you know, Mariano Rivera, okay, with the splitter. You need more than one pitch. Okay, sure. You need more than just one trade. You have to end up picking the right trade for the right market. And the thing that I love most about what Paul's developed here, and we've worked together for a lot of years, is that it really does allow him to choose the right trade for the right market conditions.
Right. I just, one more thing before Roger asked about using TOS analytics, and you're absolutely right, Roger. TOS analytics are, I don't know how reliable they are. I'm not going to say they're not reliable. I don't know how reliable they are. What I do watch, what you didn't see, was the spreadsheet that I have where I calculate all my own Greeks and all my own IVs. So I don't use option view or TOS or anything else. I look at formulas that I felt give me the best accuracy for what I'm doing. And then you just follow whatever, you know, as as long as you're consistent, you follow option view, you follow toss, you follow, as long as you know the trade works in it, and then, yeah, I've grown to distrust most of the calculated options. I bought data from iVolatility, and once I ran their numbers, historic numbers through my delta, my spreadsheet, I came up with different IVs than they gave when they sold it to me. So I don't even use theirs either.
And it really is important that you end up knowing how a trade is going to end up, the characteristics of it, what's going to make it go up, what's going to make it go down in terms of its value, understanding that you are truly trading spreads, right? One strike against another. So, Paul, once you end up getting your stuff down, promise to come back and speak to us again.
Sure, because this is very in-process thinking, so, I'll come back when I have more slides.
That's great. Okay. We really appreciate that. Thank you so much.
If you'd send me these slides, I'll put them with the recording.
Okay, that sounds fine. Actually, I think, Jim, you have these.
I do have them. Tom, I'll send them to you.
Okay,
do I have I don't have the latest copy, right? You didn't make any changes since? Okay.
No changes.
Tom, I'll send them to you as soon as we're done here. Thank you.
Great.
Thank you so much.
Thanks, everyone.
Thank you. Have a good night.
Bye.